Reserve Bank of India has issued a fresh notification, and according to that new notification, Reserve Bank of India has lent infrastructure status for affordable housing. How will this change dynamics for the Indian housing market? Could we be staring at a huge price war in coming months and in coming weeks? To discuss that and to understand how the dynamics of the Indian housing sector will change, I have with me Mr. Keki Mistry, Vice Chairman of HDFC Limited. Mr. Mistry, good morning and thank you for joining us. Your first reaction to the news: Reserve Bank of India has lent infrastructure status for affordable housing, and also infra status for home loans has been given for loans up to 50 lakh with some riders.
I think it's tremendously good news for the housing sector, and one must compliment both the government for all the benefits that were given in the budget and RBI for what they've done now in terms of giving this benefit to the housing sector. So I think it's a great thing. It should help in, to some extent, bring down the cost of borrowing, and also it will help the middle class person to buy a house. Also, the limits that they've defined in terms of loan amount are now a lot more realistic. So it's not very small size loans, because, you know, in cities like Mumbai and Delhi and places like that, you can never get a property if you take a loan of 20 and 25 lakhs. So they made it a little more reasonable. So for the 6 metros now, the limit is 50 lakhs rupees loan amount, and for the smaller towns it is 40 lakhs rupees. So I think these are much more realistic limits.
Also, Mr. Mistry, banks can issue long-term bonds with a minimum maturity of 7 years to raise resources for lending to affordable housing. Your view on that? By how much can the borrowing cost come down for housing finance companies?
Difficult for me to put a number. I think it's best if you were to talk to a bank. But there are two ways banks can do it. Banks can either lend for housing, or they can subscribe to a bond or a debenture that we issue for a 7 year or a longer than 7 year term. So they can subscribe to a debenture that we issue, and that money would be used by us then for giving this category of loans to customers.
Right, Mr. Mistry, Reserve Bank of India has also eased norms for long-term bonds for banks for infra financing, and has issued norms to ease the liability side with minimum regulatory norms. Do you see this as a huge positive for banks and also for the infrastructure sector?
I think like the affordable housing sector, even the infrastructure sector has got a huge benefit, both from the budget as well as from this RBI action. So it will enable banks to take a more active role in terms of lending to infrastructure. Banks will be able to borrow longer term money, more than 7 year or more than 7 year money. And on that 7 year money, that money will be free from CRR and SLR requirements. And therefore, effectively, the cost of funding for a bank for long-term funds will be lower. And it will then give them the ability of using that long-term funding for creating long-term assets.
Both the government and RBI have slated a lot of measures to boost housing sector and housing finance space. Do you see this translate into higher competition within the segment, especially for NBFCs?
My sense is, as far as the banks are concerned, most banks are today lending money to customers at the rate which is very close to the base rate. And as you know, banks cannot lend money to a customer or cannot give a loan to anyone at a rate which is lower than the base rate of the bank. And therefore, unless banks revise their base rate downwards, they will not be able to, reduce their rates in any significant manner. And if they revise the base rate downwards, then the entire assets of the bank will get repriced downwards, which may be difficult for banks. But however, if the bank was to subscribe to a bond that we issue, for example, if someone like HDFC was to issue a bond of, say, 7 years or more than 7 years, and the bank was to subscribe to that bond, then the subscription to the bond will then be free from the priority sector requirement, as well as the long-term funds that the bank would have raised to give us that money would be free from CRR and SLR requirement. And a bond can be subscribed to at a rate which can be lower than the base rate of the bank. So my sense is, as far as the funding for housing finance companies is concerned, this opens up a much larger vista or a much larger ability for banks to lend to housing finance companies.
So do you expect the cost of borrowings to come down, and will they translate into lower interest rates for home loan borrowers?
Yeah, that always happens. That is an ongoing process. Whenever cost of funding has come down, we have always passed the benefit of a lower cost of funding to our customers. And as soon as we start seeing concrete numbers coming through and we see our cost of funding coming down, which hopefully it will, we will certainly pass that benefit back to our customers.
And do you see improved home loan growth at the system level post the budget and RBI norms?
My sense was that last year, if you see, I don't know for the entire sector, but if we look at ourselves, our individual loan book growth after we had back loans sold in the last 12 months was 26% on a large base. From what I recall, reading from the RBI numbers, RBI comes out with a report on segmental deployment of funds by banks, and that shows the growth of housing loans in the banking system, if I recall right, around 17%. So I would say all in all, the growth would have been about 20-odd%, roughly, very, very roughly, for the sector. So my sense is that with the kind of demographics we have in India, young population, increasingly more and more people need to buy a house, very low penetration levels, my sense is that kind of growth number can sustain for a very long period of time.
Now for HDFC Limited, will you now look to grow your market share more aggressively as competition surely will intensify?
I mean, we would always, there is no business that we turn down. So naturally we would, unless and until we are not comfortable with the credit quality. So of course we will go out aggressively and start sourcing more and more business.
So can we expect any immediate changes to interest rates from you, or at will we will see this in some time to come?
So immediately we would not do anything. We would wait for interest rates to settle down in the system, understand how much funding costs have changed, and whenever we see that benefit coming through, as I said, we will be very quick to